First Republic Bank is now in the hands of J.P. Morgan Chase after a deal with federal regulators to avoid another bank collapse in recent months.
Financial advisor Sean Toll is here with us again live. Sean, it's good to see you as always. Let's start with a couple of basic questions so that we can understand this. What does it actually mean when we say government regulators sold First Republic to J.P. Morgan? And then, is it a good thing for consumers, for borrowers, even for the government to now be creating this massive banking entity?
Well, let's take that first question. Basically, what happened is the feds, if you will, took over First Republic Bank because they saw a massive decrease in their deposits, similar to what happened to Silicon Valley Bank. Like Silicon Valley Bank, First Republic had very, very large depositors, and they started to get a whiff of troubles, and they started taking big withdrawals out. And when First Republic reported its quarterly numbers just recently, it reported some larger withdrawals, which then started that withdrawal demand process again. So the Fed stepped in and stopped that and took it over. If you recall, the Feds had arranged a many billion-dollar infusion of funds from large banks such as J.P. Morgan back in March to help stabilize it because they had big concerns about the banking crisis that may happen in the U.S. So the J.P. Morgan has stepped in. It's going to be buying all of the assets at that bank, and I believe this morning First Republic opened up as J.P. Morgan. So hopefully it provides some stability. Now, with regards to your second question, creating such a large behemoth, J.P. Morgan was already the largest bank in the U.S., so this certainly does make it bigger. But they were the only ones coming forward with an attractive deal, if you will, for the Fed. So the J.P. Morgan is under much stricter regulations than the smaller banks, and they're too big to fail, is what the term is known as. So I don't see a big problem, certainly for us as consumers.
Now, Sean, First Republic Bank does not service New Hampshire, but they are in Massachusetts, so it hits close to home. Do you see any vulnerability here with the banking industry in the Granite State?
I really don't. If we just look at First Republic, they are a coastal bank. They went after the very big, wealthy clients on the coasts that we have here in the U.S. And with this deal, the FDIC is going to cover all depositors above and beyond the $250,000 limit that they have. So there's plenty of safety there. We don't know yet, but I'm hoping that the more local banks we have here in New Hampshire and even some of the regionals have done a better job at managing their interest rate sensitivity in terms of their investments. That's what got Silicon Valley Bank. That's what got First Republic. They had a lot of investments in interest-bearing notes. When you have a rising interest rate environment, those levels or those values drop, and they couldn't satisfy those withdrawals because they had lower asset levels. I think we're doing a better job here at some of the other banks, and a lot of banks have already reported, and we didn't see anybody coming in with big concerns.
Sean, you think that banks hold a lot of mortgages, right? So what about this new White House policy? It goes into effect today. It's adding a surcharge to the mortgages that good credit holders are taking out to basically cover those who have lower credit scores. Does that impact the New Hampshire housing market, the American housing market?
Well, it's a bit of a moral dilemma if you think about it. Those people that have done well and saved and can afford a mortgage at a lower rate now have to subsidize other more risky mortgage holders. So listen, what it's going to do is it's going to make mortgages a little bit more expensive for those that have good credit. And those that don't have good credit, they're now going to be able to potentially get a mortgage with some subsidies. There is danger in that. We saw that in the global financial crisis back in 2008, when we started all of a sudden creating a market for what they call subprime loans. Those are loans that don't have very high, or borrowers don't have very high credit scores. There was a lot of other things at play as well, but you have to be very careful. The banks have to be careful with the lenders that they lend their money to, because they have to get that money back. And if they don't, that will hurt the other depositors as well as the shareholders.
Okay, we're out of time. It's always good to see you. Thank you for your expertise again, Sean Toll, financial advisor.
My pleasure.
Appreciate it.